So my name is Christopher Mo Dege. I will take you through our views on the rig market, starting with the macro perspective, taking a look at the cyclical demand potential of this market, viewing that in relation to the structural changes that we've seen in this industry over the course of the past 7-8 years, and then take a look at the best investments, or highlight a few companies that we find to be very good investments in the current oil market and political climate in Europe. Before I start, there's one key message that I want to keep in mind throughout this presentation, and that's if we rewind a few months back in time, back to December, when we sent out a sector report, the market was already starting to look very constructive and starting to look up. Obviously, since then, there have been some big changes in the political landscape and in energy markets in general in Europe and in the world that has the potential to accelerate what was already a very constructive market. So to that point, I'll just start by reminding us as to where we were from an oil market perspective and from a rig activity perspective. So what's turned up on your screen now is the last 12-month average Brent price over time. So average Brent over a 12-month period over time. And if we look at where we were in December, we can rewind back to mid-2018 to find a similar oil market environment. And I'll get back to why we look at this from an historical perspective. But in mid-December, Brent had averaged at about 70 for 12 months, and that was the case also in mid-2018. Now, if we add activity levels on top of that, and the blue line that just turned up on your screen is the number of rigs working on contract at any given point in time, and do the same exercise, we see that it was a similar activity level in mid-2018 as well. So both the oil price environment and the number of active offshore rigs were at similar levels to where we were in December. So why is this interesting? Obviously, we can look at what happened in the time that followed mid-2018. And just as a measurement, if we measure the increase in the number of active rigs that worked in the following 12 months, it increased by 9%. So what we can say at the very least is, from an historical perspective, the oil price environment such as the one we saw in mid-2018 and in mid-December 2021 was very constructive for rig demand. If we add another 6 months to that and look at the 18-month period that followed from mid-2018, the number of active rigs that were working increased by 12% over that time period. Now, obviously, if you stand in the middle of 2018, add 18 months to that, you very quickly come to the beginning of 2020, which was the start of the pandemic. We all know what happened. Energy markets collapsed on the back of lower demand. The rig market followed energy markets, and activity plummeted, as was the case in many industries, right? So important to keep in mind, the oil price environment in mid-December was very constructive. We know that it can support an increased activity level for offshore drilling rigs, and also the rig market was actually heading in the right direction pre-COVID as well, and was on its way towards recovery. Now, obviously, the months that have followed December have been very eventful in the oil market. Obviously, average Brent prices have come up meaningfully. Current Brent is well north of $100. And this is, needless to say, supportive of an accelerated increase in activity levels in the rig market. Now this slide has become very busy, so if we just take away all of the notes and stuff, one important thing to keep in mind is what you can see on the slide now. Number of offshore drilling rigs has not increased under contract. Right, so all of these the supportive oil price environment and so on, it's still only based on predictions. So number of offshore drilling rigs, relatively flat the past period in time. So we need to dig into deeper lead indicators in order to find evidence for our expectation of increased activity levels going forward. So one way to do that is what you're seeing on this slide, and that's counting the number of rig days that are being awarded within a given time period. So what you can see on the left-hand side of this slide is the number of rig years awarded on a trailing 12-month basis. Obviously, back in 2011, 2012, we came off very, very high levels. It plummeted together with the oil price in 2014, and then it bottomed out around 2015. So this is the number of rig years awarded for floaters, I should specify, and we'll get back to jackups afterwards. Then from mid-2015, it slowly improved, fairly stable and surprisingly stable, I think, when looking at it on a 12-month basis, up until COVID, where it again plummeted like many other markets, but it has recovered very quickly since then. So the number of rig years awarded now north of 100 in the floater market. So that tells us something about the volumes coming into the market. Obviously, it's important to look at those volumes relative to activity levels, and that's what we see on the right-hand side. So in short, what the graph on the right-hand side tells us is the number of rig years awarded versus the number of rig years used. So it measures new activity coming in versus activity at current. So anything above 1 is a positive lead indicator of increased activity levels in the time to come. And now, for the first time in a long time, we're seeing a book-to-bill above 1 in the floater market. Right? So this is indicative, or strongly indicative, of increased activity levels in the short to medium term. So very positive development in that market, and the best market on that metric we've seen in a long time. The jackup market is a bit of a different story. So not going to rewind back to 2011 in this market. What's worth highlighting on the graph to the left-hand side is that the number of rig years awarded in the jackup market was actually at pretty high levels prior to COVID-19. So that market had started to move relatively quickly and started to look pretty healthy prior to the pandemic. Then same story in this market as well, and we've dropped down to relatively low levels. Now, if we look at the book-to-bill in the jackup market, we're still below 1. That has been somewhat surprising and somewhat disappointing. The jackup market has been trailing more than one would have expected due to it being more exposed to a short cyclical market. And this has been a concern over the course of the past few months. But what should be taken into account and should be noted is that the activity behind the scenes that are not yet visible in figures and the tender processes in large markets such as the Middle East are very supportive of an assumption that this market also is starting to move in the right direction. And the reason we mention the Middle East is obviously it's 35% of overall jackup demand. And we're now hearing a lot of chatter about the Saudi Aramco tenders and Qatar gas tenders that those of you that follow this market closely are very aware of. And we'll get back to the potential impact of these tenders on utilization in just a bit. Now, we've seen that the oil market is supportive of an increased activity level for offshore drilling rigs. We've seen that awards are coming back and are strongly indicative of increased activity levels for these assets. Now, what we want to convey on this slide, on the left-hand side, is that we're already seeing evidence of offshore economics being very attractive. So if we start with the dark blue line on the left-hand side of this slide, it measures the number of rigs working for IOCs at any given point in time. So IOCs are independent oil companies that are more agile, more flexible, and more responsive to the prevailing oil price environment, and that are less exposed to the structural shift towards green energy, such as majors. So what's obvious from this graph is that they've responded pretty quickly to the change in the oil market, and the number of rigs working for IOCs is up 70% since late 2020. That has been counteracted by the fact that majors have been dropping off rigs for several reasons, but one of those reasons has obviously been their increased focus on renewables. And that's a big, complex question that's hard to answer in just a few minutes, but it is worth noting the change in semantics in Europe in general as to the attitude towards hydrocarbons following the geopolitical turmoil that's followed from the invasion of Ukraine. So a shift in semantics, making it more approvable to invest in hydrocarbons, is absolutely something that can benefit rig demand from majors as well. And then just lastly on demand, this is just to show that this is not only evident in the rig market, or it's not only the rig market that is indicative of increased offshore activity levels. On the right-hand side of this graph, you can see the subsea opportunity pipeline measured by Technip FMC in the number of billions to be awarded in the subsea space in the time to come. So bit subtle in the graph, but Brazil has been lead in this increased activity level for the past few quarters, or the quarters leading up to the past few quarters, I should say. And then we've seen a broader based increase in the subsea pipeline in the rest of the world as well. Not only the rig space, this is also starting to become evident in other parts of the value chain as well. So long story short on demand, oil price environment is very constructive. It was constructive already in December, and then obviously the movement we've seen since has the potential to increase or bring that recovery that was already expected forward. Now over to a very important point, or several important points to be made, is the structural changes we've seen in this industry the past 7-8 years. And it needs to be taken into account when you have that potential demand increase as a backdrop. So one very important change from where we were in 2014, and we'll make that comparison later on, is the change in the number of rigs that are available for contracts. Right, so starting with the left-hand side, you can see the development in the floater fleet, the active ones on water and the order book. From 2014 up until 2020, the number of rigs that existed in the world dropped by 35%. So big drop on the back of a lower activity level. Then from throughout the 2020 and 2021, that number dropped a further 15%, mainly on the back of restructurings, consolidation, and several good excuses to take out all capacity and further improve the market balance in the floater space. So a dramatic decline in the number of rigs that can be bid in for contracts in an expectation of higher demand going forward. So that's a structural improvement. To bring more rigs into the market, you need to build them, which does not seem likely at current, and we'll get back to that when we look at the pricing of these equities. On the jackup side, less of a dramatic drop in supply. It's a different market. It's a more stable market with more stable customers, so the need to reduce supply is not as big. But I think it's worth highlighting the positive effects we've seen from consolidation and restructurings between pre-COVID and at current, where jackup supply is down 10%. So very positive development there, even though it's not as large as in the floater space. So if we've touched upon demand expectations and where demand is headed. We've touched upon where supply has moved over the course of the past few years, and that obviously brings us to the market balance. So what's shown on this slide is the number of contracted rigs measured as a percentage of the number of active rigs that can be bid in for contract. So there are several utilization figures that can be used to give a sense of market tightness. This is the best one if you want to give a sense of short-term market tightness and short-term day rates, and we'll return to day rates in a bit. So as you can see on the left-hand side, 7-gen utilization is now north of 90%. That has led to a pretty handsome increase in day rates and fixtures we've seen. 6th-gen utilization is trailing. The market that has moved fastest is the US GOM, where you prefer 7th gens. So 6th gens are trailing somewhat, but also being brought higher by both scrapping and increased demand. Then on the right-hand side, the jackup story that I've touched upon a couple of times now, it's been a bit disappointing. It has been trailing the floater market, but what you can see from the dotted line bringing us up to 92% is just the hypothetical scenario of an incremental demand of 20 rigs coming from the Middle East. And that's just to show how quickly that utilization figure can turn higher if you start seeing that sort of demand from the Middle East, which is becoming increasingly probable in the current oil price environment and political environment. So the market balance is improving quickly on the back of both higher demand and lower supply as a backdrop. So before we move to day rates and what we're seeing in the market there's just another point I want to make regarding the structural change to this industry over the course of the past few years. I think it's hard to spend too much time on this slide because it is really very important for sentiment tied to the rig space and the way negotiations are going. But this is just showing the net interest-bearing debt of the industry in Q1 20 versus year-end 2021. So we've included all of the drillers that have restructured and also the drillers that were sensibly financed to begin with. And if you measure their debt load against each other, it's down 95%. So obviously this does something with the risk tied to the equity. It makes the space more investable for a broader portion of capital markets. And also fundamentally, it does something with the way these companies bid in their assets for new contracts, right? So in Q1 20, they were all scrambling for contracts, thinking about their liquidity runway, their net debt, their next debt maturity, whereas now they can sit patiently and negotiate on the back of a tighter market balance. So this has really changed discipline in the industry together with consolidation, and it's an important factor to think about when you as investors consider investing in this space. So it's a very positive development on the financing of the assets as well as the market balance of the assets. So I guess the final thing to touch upon from a macro perspective and from an industry level is day rates and where the market balance is. So one way to do that is look at utilization for modern assets over time versus day rates over time. And I guess first thing we can do is take a trip down memory lane, and an increasing number of market participants and investors are starting to make the comparison of the current market versus what we saw in 2005. So I'll just remind myself and everyone listening in to where we stood in 2005. So the dotted line in pink is January, February 2005, and the pink box is Pareto's estimated day rates for 2005 back in January. So the estimate was that day rates were going to move to 250, 285,000 a day. Within the course of 6 to 9 months, Leif Eriksson and Eirik Raude, two old rigs that no longer exist, had received contracts of 400 to 465,000 a day. So that market can move very, very quickly if the market balance shifts in favor of the seller and not the buyer. So if we wind forward to where we stand today, we can see that the market balance is poor, but quickly moving towards 90% on a marketed level, or as measured by marketed rigs. And then it's a different story if you start talking about the cold stacked assets and new builds and so on. But day rates have already moved 35%. So from the low 200s towards 300 within the course of a couple of years, and from pre-COVID levels. So not taking the Russian percentages of low wall fixtures after COVID hit and high end fixtures now. So the last dot on the light blue line that we've used here is about 300,000 per day. When we speak to companies in this industry and try to dig into where they are bidding in their rigs for long-term contracts now, they're starting to talk about 400,000 a day. So obviously that's a big jump up from what's shown in this graph, and it tells us something about the market mentality at current. So with that, I'll leave the day rate and utilization and industry fundamentals to the side and move to investment opportunities in this space. I'll start off with Odfjell before moving to the larger European names. So Odfjell is an interesting company for several reasons. One key reason is that the NCS and the UKCS, so Odfjell's core markets, are of an increased strategic importance in Europe now versus a few months ago, and I'll get back to that point. But first, just on Odfjell, a lot happening in that company at current. They're separating out Odfjell Technologies and Odfjell Drilling, the Modo business, into two separate companies, separately listed companies. So if you buy the equity today, you'll end up with two equities. So just keep that in mind. What I'll focus on is the Odfjell Drilling business, which stands for between 85 and 90% of EBITDA, so the majority of the value in the company. If we look at that Modo business, you here see the multiples at which it is priced if we make some high-level assumptions on where OTL will trade once it does. So here we assume between 70 and 150 million of equity value for OTL, and we're left with a residual in ODL. So on our estimates, Odfjell is currently priced at 4.5 times EBITDA. One of the reasons as to why it's such an interesting company at current is because if we wind back to the previous election in Norway, we started getting concerned about the political risk tied to activity levels on the NCS. There are quite a few political parties that have focused on reducing exploration activity, maybe even stop awarding new licenses in Norway, shutting down Norwegian shelf, right? So that's a very strong argument as to why you should see a multiple contraction for a company very exposed to that market. Needless to say, making the argument to close down the NCS, which exports or stands for north of 20% of gas exports to Europe, is now becoming increasingly difficult. So at the very least, we find that assuming a fixed multiple or a flat multiple over time is not a very aggressive assumption in the prevailing market environment. If we do that, you can see the fair value of the equity to the right-hand side from 24 NOK at current and towards 50 in 2025. So at the very least, flat multiples is not an aggressive assumption, and I'm sure we can even make an argument for multiple expansion for this company. So if you look at what you're paying for this company on a per rig basis, you will see Northern Ocean and Odfjell next to each other. You're at about 300 million per rig. If you take the EBITDA contribution for a rig on mark-to-market rates in the North Sea, which is at about 330,000 per day, including bonuses at current, you're priced at roughly 4.7 times EBITDA. So similar to the estimates you saw on the previous slide. If we assume those rates to move towards 400,000 a day, you drop down to 3.3 times EV/EBITDA. 400,000 a day is just a number for most of you, but just as a reminder, this was where we were pre-COVID. So it's absolutely not an imaginable or aggressive number to assume for this market. So a good case to be made for multiples staying flat or increasing, and also a good case to be made for increased EBITDA contribution from these assets going forward. So I like the name for several reasons, pricing and thematically both. If we move to the slightly larger names in the US, we see substantial upside in these names as well. So what you see on this slide is implied values. And for those of you that do not spend as much time on this space as me, it's basically enterprise value divided by the number of rigs, and then a bunch of assumptions in between to make all of the companies comparable. So I'll focus on Valaris and Noble and Drillco, or Valaris and the combined Noble Drillco company, just because it's probably the names most relevant to most of you, being large cap names with relatively good liquidity in the US. So these numbers obviously tell us something about what capital markets are pricing assets at. And a good comparison to those values is what the industry is paying for similar assets in the second-hand market. So what popped up on your screen in green bars is the price paid for the Cobalt Explorer and the Ocean Rig Crete, including a few assumptions regarding the mobilization and spares and so on needed to make these assets comparable to Valaris and Noble and Drillco. So we start off by the Cobalt, which was a cash buy by Turkish Petroleum. We can compare that asset value to enterprise values in Valaris and Noble and see that there's 30 to 50% upside from where capital markets are pricing these assets to where the industry is pricing them. So Cobalt was the most relevant data point to look at a few months ago. Since then, obviously, a lot has changed, and we now think it's time to look towards the Ocean Rig Crete. It was an option to begin with. We didn't find it relevant because it wasn't a cash buy at the time. That is now looking to be exercised, and asset values are on the rise. So Ocean Rig Crete is a fantastic rig, but it's still worth comparing these enterprise values to. And then we can see a 60 to 80% upside just based on what we're seeing in the market for second-hand values. So this is a sort of reality as is, and before we start making hypothetical assumptions regarding asset values going forward. If we do that, there are about 6 7th-generation ultra-deepwater rigs left on yards that are not called for by an industrial owner at the time being. Where those second-hand values will trade, time will show, but this range shows where we were in 2018. And again, repeating myself, but the market looks a lot like where we were in 2018, and making assumptions regarding rising asset values is not being aggressive. So if we do that, the upside in these equities obviously starts looking very, very attractive. Last point I want to make, and this is not to say that we're going back to replacement, but the gray bar that popped up here is the estimated cost. And when I say estimated, it's more rumored ballpark because no one knows, because no one's even thinking about it, of replacing an ultra-deepwater asset from a yard at current. And in addition to paying between $800 and $1 billion for that asset, you'll have to wait multiple years before you get it. So this is not to say that we're going to move back towards replacement values in these equities, but this is just to show how far away we are from incremental supply from yards in this market, with the exception of those that are already built. So to that initial point we had of the floater fleet having dropped 40% in size, we're not even close to pricing in more floaters coming back to this market, which is a cap on supply and positive for day rates. So all in all, Valaris, Noble Drillco, we find very attractively priced at the moment. And obviously, if we're starting to talk about scenarios such as replacement value, you'll see a lot of upside in the lever names such as Transocean as well, even though we might not think that the upside is sufficient relative to the other companies. So that's implied values. Just before we end my part of the presentation, taking a look at multiples and sensitivities to day rates as well. What you can see on this slide is EV/EBITDA multiples for the companies I just mentioned at 300,000 a day, 350, and 400. So 300,000 a day, again, it's about where the market is today. Attractive on multiples, and the US names with fully utilized fleets are close to where Odfjell is priced at the moment. 350,000 a day, We haven't seen many fixtures in that range, but we're not far from it. And as I mentioned, 400,000 a day is the behind the curtains chatter of the industry at current. So quick, to begin with, the companies aren't priced, or these are value companies with low multiples to begin with, and there's a good case to be made for increasing EBITDA profiles in the time going forward. And then just to leave us with food for thought again, and to show how unrealistic it is to think about incremental supply from new orders in this market going forward. If you want to build a new rig today, the day rate at which you'll need a contract, who knows? But when humoristically you talk to these companies as to what they need, they're talking of $1 million a day, right? So we're not even close to pricing in a recovery or a super cycle in this industry, either on multiples or on implied values.